So the Texas Roadhouse is reporting earnings today, and I wanted to talk about this company and investing into it as a dividend stock. So let's look at it using our DripCalc stock research tool. So if you look at their performance over the last 10 years, they actually did amazing. They're up 520% over the last 10 years. That's if you reinvested your dividends. And even if you didn't, it's 462%, which is an amazing return. And if we look at their price CAGR, it grew by 18% compounded annually. So every year it grew on average about 18% a year. That definitely beats S&P 500. And their dividends, they did even more amazing, up about 20% every year. If you look at the dividend chart all time right here. So from 2011, they didn't really grow with that. Well, actually, from 8 to 9%, that's a pretty big growth. That just doesn't look that big on this chart, but like over here from 9 to 12%, that's 33% in 1 year. That's an amazing increase. But overall, their dividend is up about 20% on average per year. And you can see the price basically follows the dividend. So the dividend yield curve is not really going down. It stays more or less flat. That means the price does not outpace the growth of dividends, and you can see this in terms of CAGR. Actually, dividend grows faster than the price, which is good for dividend investors, okay? And here you can see the total performance with and without dividend reinvestment. So if the stock did so amazing, why I am on the fence about it? Now, they'll report the earnings today and we'll know how they did last quarter, but if you look at the dividend safety, this is where I get concerned a little bit. Now, if you look straight at the dividend payout ratio, it seems pretty good, around 57% last quarter, 45 here, 51. So like, below 50%, below 60%, which is pretty safe. If it was even lower, that would be nice. But then their dividend yield would probably be much lower. Under 60% is pretty safe. But if you look at their dividend to free cash flow ratio, it's 278, 322, 323%. And that's pretty scary. Like over here, it was pretty safe. One quarter was 100%, but mostly way below 100, But the last 2 quarters is just not looking very good. And this is concerning. And let me show you why it's concerning. Now, we'll come back to this free cash flow and free cash flow per share, but let's look at their cash and debt. Okay. Now, over here, this is when they were like around 50-60% free cash flow to dividend, or vice versa. But then, as the free cash flow dropped, their cash started going down like crazy, and their debt is actually going up. Now, this is not huge amounts, AT&T has like 150 billion of debt, and Verizon, but this is not a large company, and they have about 10 times more debt than they have cash, and their cash pile is just depleting. Like they had $500 million over here in 21, and now it's only 70 million in cash. Now we'll know a little bit more today, but I have a feeling they're actually using their cash, and maybe that, but probably not, because like if we look over here, their capex is actually going up. So they're opening new restaurants, which is good for business, and eventually those restaurants start bringing in profit. But I feel like they're paying dividends with cash, because their free cash flow is basically what they have after all the expenses to pay the dividends. And the last 2 quarters, they had 17 cents and 20 cents free cash flow per share, and they pay 55-cent dividend. So last quarter, they paid 35 cents of that dividend from the cash pile, not from the earnings. And that's pretty concerning to me, guys. And look at this price chart. It's just like ripping. Like it's near all-time highs. I think all-time high was like 136 a couple days ago. And today it's like 135 something. 135. I mean, overall, this is an amazing company. They had amazing growth. Look at this. Look at this revenue growth. It's like just non-stop going up. It's like a hockey stick, Over here, Corona, they had a negative net income, and the revenue dropped pretty significantly. But we all know why. Everything was closed. They couldn't operate. So yeah, that's normal. And they picked up from there and just like, skyrocketed. So before Corona, the highest they had was 725 million. And over here in 23, they already at like 1.2 billion. That's like $500 million in revenue in a quarter. That's a lot for a restaurant company. Now, just so you know why I'm talking about Texas Roadhouse, like, guys, if you compare Texas Roadhouse to Google, it outperformed Google. Like in 10 years, it returned 528%, and Google only did 374. Only, that's amazing. But still, it's look how they did. Most of those 10 years, they actually were beating Google. The high flying, high tech, AI, Google, YouTube, search, all that good stuff. And this boring restaurant stock is beating Google. And it's paying dividends. And like, since you invested in it, if you reinvested your dividends, you are up another 75 shares on your initial purchase of 392. Now, we're going off a $10,000 initial investment. And back then, Google was pretty cheap. I remember I wanted to buy Google in 2009. I just didn't have any money. It was before split, it was like $160 back then. And then post split, it went up to 1600, tenfold. Anyway, so yeah, they had an amazing performance, amazing dividend growth, amazing numbers, and as far as EBIT, as far as earnings, even net income is not that bad. Let's look at the net income without the revenue. So just by itself, yeah. So you see it's a really nice upward momentum for this stock, and let's see if we have some kind of pattern. Usually, like quarter one is usually the high, so I don't think they're gonna do that well today. So usually quarter four is not that great for the stock. So yeah, it's usually closer to the lower end. Like over here, they did pretty well compared to the third quarter. Okay, so but this is coming out of Corona, and again, fourth quarter was pretty low. So I don't think they'll do that amazing today. As far as net income, let's check out revenue. So first quarter is usually their best. Yeah, not always. So it's the net income where they kill it in the first quarter, but their fourth quarter, which is reporting today, usually not the best. So if you look at other metrics, shares outstanding, they're slowly buying back shares, which is good, not as fast as some other companies, but over 10 years they bought back about 0.66% per year. So I think that's like about 4% overall. I'm not going to do math right now, but yeah, they're expanding pretty heavily. You can see their capex year over year. They spent more, like 36% more on capex than they did in previous year. And over the last 10 years, it's 10%, 9.5% increase in capex. But their other metrics are just great. And again, if you look at this chart over here, guys, so this yield curve over here, this is dividend yield curve, not the interest rate curve. It's pretty straight line, like it's up and down with the price movement and all of that good stuff. Over here it was just like really good, and over here it was really bad. But this is because of the price at the time of the dividend payout. Okay, but overall it's straight line, so it's not decreasing. Like for Microsoft, it's just straight line down. Like going down the hill, but this is staying. So the price is basically following the dividend yield, which is good to hear. But yeah, I hope they report good results today. And would I buy this stock? I am not sure. Probably not at this valuation. Like I had this stock, I bought it. Let's look at 1 year chart, just like right around over here for like $91, $92. I bought a few shares, and then like when it ran up to 110, I sold out. I definitely did not expect 135. Right now, but I would hold out, but I think even then it was a little bit pricey, so I sold. And I wouldn't buy it today, even though the dividend growth is amazing, the share price is amazing, but I think it's kind of hitting the top of the range. Now, this is not a charting software like where you see the Bollinger Band and the moving averages. This is not meant for that, but I still think that this stock is a little bit overpriced for my liking. I would hold off on this, and I would want to see how they do on the free cash flow, because this is really concerning that they're burning cash to pay out dividends, possibly even using that. So if we go from here, so 700 million debt, 730, so they increased the debt by like almost $40 million in three quarters. Yeah, I don't know, guys. And they decreased the cash pile from 156 to 70, or 85 million decrease in cash pile. So overall 100 million difference. Yeah, I wouldn't feel safe buying it right now. Definitely wait for the earnings, and I think this price will come down. And if they can actually cover this amazing dividend growth, then I would probably invest in it. Let's just hope they report today that the free cash flow went up, because this is a little bit concerning for me. And so guys, I am actually using this DripCalc Pro software for research. And if you want to try it, we actually just launched it. And so for our new subs, we're offering a 30% lifetime discount. So if you sign up today, and even if we raise prices in the future, you will always get the 30% off. And you can actually try it for 30 days off, 30 days completely free, and you can cancel anytime. So if you want, just try it. We will leave the promo code in the description for this video. And it's only first 200 subscribers that sign up. So don't wait if you enjoyed it, and because that lifetime 30% off might be gone. Alright guys, so thanks for watching. Please click like if you enjoyed this video. Subscribe to the channel. This is a new channel. We're building it out, so any help we would appreciate. Thanks for watching, and I'll see you in the next video.